Okay, I did a whole 20-minute video, and my brother rang me, and obviously my ringtone will get done for copyright. So, and I can't be asked to edit out, so I'm redoing the whole video again. So, let's go back to it. Here is Monday to Friday, the weekly range. Now, in this weekly range, we were bullish because we were bouncing off we swept liquidity and we were bouncing off of this order block here, as well as this large order block here. So I was expecting this week to open, go up, and close bullish. So we go down to the daily, and obviously we come to this fair value gap on Tuesday, creating the low of the week, which is the most likely scenario. And then on Thursday, I was bearish because of the fact we were in this inversion fair value gap, which is also in a premium of the range. And on a Thursday, we likely see a reversal in trend. So I'll check everything on the charts again. Go back to the 30-minute. So this blue line here is the weekly open on Sunday. So this is the classic AMD model. So accumulation, manipulation on Tuesday, distribution for the rest of the week, and then reversal on Thursday, and then possible continuation on Friday, but most likely chop around or move lower. So what we'll do now is we'll look for extension targets, which I've already, well, they're not the extension targets, this is the extension targets, but I will show you where I was thinking price was going to go and stop for the week, so from the low to the high. So in the previous week, from Monday to Friday, we see this impulsive move higher on the 30-minute time frame. So we anchor our fib from the body's low to the high of the impulse move, and we extend. So I've already drawn out this zone. This is where I thought price was going to go to for the week, and usually on Thursday the high of the week is put in because all the lows. So if it's the high, we reverse. If it's the low, we reverse up. So we trade lower, come up, come into these levels, but I'll show you how to get the targets. Basically, it's just overlapping. You've got to just overlap these levels and find out where there's grouping. So here as well, we'll overlap. So, and then we'll go back to here, and then take it to the low, which was Tuesday. Again, we have these levels here and up here, but we obviously already reached these levels here on Wednesday. So then we keep anchoring and just find overlaps. Obviously we had an overlap here because there was a price level here. We had another overlap here. See how it was grouping together in this zone here? And then we shall go back to here, and then we'll start anchoring it here. Optimal trade entry long. And then again, obviously these targets were hit. Take it to this. We have more grouping up here. Another group here. So you can see how this zone is where I believe roughly, this is rough estimates on where the high or low of the week is going to be. So we had all this grouping. I did put horizontal lines and everything to show, but it takes too much time. But anything, so once we create the low of the week on Tuesday, which highest likelihood of creating low or highs of the week are on Tuesday and Wednesday, and can do on Monday. But best case scenario, Tuesday. Always the best case scenario. So anything above, we are bullish until Thursday. So Wednesday, we look for a continuation, and then Thursday, we look for a reversal. Now, I'm focusing on Thursday because I was looking for a reversal because, like I said, we were in a daily inversion fair value gap, which was also in a premium, so it could be seen as a premium array. So we'll go to the hourly chart now, and we'll go over the interbanking system from 2 p.m. till 8 p.m. We look for a consolidation phase. So the banks and institution can basically create open float for the next day. So with this, we can only look for anywhere between it's not zero, but 0 and 40 pips. Anything over 40 pips, it's not a high likelihood of a good trade the next day in the London session. So we can do this by measuring from 2 p.m. the wicks to the high, 20 pips, perfect. Again, from the candle bodies, perfect, 14. So we're in the range. So now what we do, we look for 2 standard deviations in London session for the Judas swing for the protractionary phase. So we always use the bodies, so here to here, and this is the protractionary stage. Right here, and then I'll put that as parabol, and then from here to here, put that as blue. So I could take this fib off. So we're looking for anywhere between 1 and 2 standard deviation. And obviously we need more confluence in our bias, so we look left on the hourly chart. We have this fair value gap right here, bearish fair value gap, as well as coming in at the 2 standard deviations. So we'll go to the 50-minute time frame. We have our Asian range here from 8 p.m. to midnight, Asian high, Asian low, and then we look for the Judas swing in London, but that can be anywhere between 12 or midnight to 5 a.m. So we see here some consolidation, and then 2 a.m. hits, and we start rallying higher, trapping retail traders into breakout trades, going long off Asia highs or this high, etc. And what I'm looking for is a short, because it's Thursday, end of the week, comes to the end of the week, targets will be hit for the week, etc., etc. So now what I like to do is find significant highs or Asia highs and like measure out 10 to 20 to 30 pips in price above or below the level, depending on my bias, on where I think price is going to go before it reverses. So we measure from this high all the way up. Well, we go to 10. It's not enough because we're not inside of this PD array. We go to 20. Still not enough. We go to 30. It's perfect. We're inside the range, and you'll notice that created the absolute high of the day to the pip. But then we can also use this range here, this high, before 2 a.m. starts. We take the measure tool, go 10 pips, not enough. We go 20 pips. Perfect, we're inside the range. Now for stops, because I measured from this high up to here, I want to see it go no further than 30 pips, because after 30 pips then my bias may be wrong and we could just see continuation higher. So where I took my entry was at this level here because I wanted to get my fill. Didn't want to just miss out on the move. So the entry would have been here. Let's stop at 10 pips or thereabouts, whatever. And then I'll take you to this hourly fair value gap here. So we have this hourly fair value gap here, but the way I came to the conclusion of exiting my full position at this hourly fair value gap was because of this, the 2 p.m. to 8 p.m. consolidation range. So what we do is we just mark out this whole range. I liked it orange, this thing. And then we project it lower. And we look for targets considering the deviations. Now it could go not 1, not 2, not 3, it could keep going down, but from the average daily range of pips, I didn't think it was going to go much further or even to this first target. Now what we look for is PD arrays in price in a discount. And what caught my eye was this fair value gap. It's inside the deviations. Obviously you see it doesn't come down to it, but I catch the high and the low of the day. And then it goes back into consolidation or retraces, like you see here. But in some cases it can go to the tick here. But there's 2 p.m. and it goes just beyond that one standard deviation, which would be here. So I'll take that off. And that was my reasoning for exiting my position at the fair value gap. So I'll take you to the 5-minute time frame. Take that off. So initial entry here. Now we look for an optional trade entry or any sort of model, whether that's unicorn model, the 2022 model, anything like that. But we look for PD arrays inside of a range after displacement. So entered short here. We displace considerably lower